So I've been buying more of a particular dividend growth stock in my portfolio, and I gotta tell you, it has some sneaky impressive numbers, like an 8% dividend growth rate over the past 20 years and an average annual return of about 10%. Pretty solid, right? It's VTI, the Vanguard Total Stock Market ETF. And you know what? I am not ashamed to admit that I'm putting more money into this boring old stock market index fund. As legendary investor Ben Graham said, to achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. By the way, I'm Russ, and I am on the straight and narrow to becoming a net worth millionaire. And we're currently 85% of the way there as of this recording. So this is what we're doing. Oh, and by the way, there's a special seekingalpha.com offer in the video description below. And I also have a free and fantabulous weekly newsletter that I send out every Sunday with thoughts on investing, on dividends, and I also share all the portfolio activity and dividends received for the week that was. Now, I thought this data from S&P Global was pretty eye-opening, and I'll have the link for this article in the video description below, but only 8.2% of professional fund managers have beaten the market over the past 20 years. And these same professionals have research teams, advanced degrees, million-dollar budgets, and yet over 90% cannot consistently outperform a simple index fund. So when you buy VTI, you are buying the entire publicly traded US stock market, which is almost 4,000 companies, and not just the 500 largest companies as the S&P 500 does, which is why I prefer VTI, although they're somewhat close in total return performance. Both also have a 0.03% expense ratio, meaning you'll pay just $3 for every $10,000 invested annually. And over the past 10 years, VOO, which is Vanguard's S&P 500 fund, has beaten VTI by 16%. But over the last 1 year, VTI has outperformed VOO by 0.20%. Let's get it, VTI. So check out this chart again for VTI's dividend growth, which shows an 8% compound annual growth rate over 20 years. I think that's exceptional consistency for buying the entire haystack. So I've begun making some changes to our portfolio. That's our net investment portfolio, and we left out any 529 college funds. So we're currently at 75% funds and 25% combined individual stocks. So we've begun transitioning to an 85-15 split, which will have 85% in broad market funds and 15% in high conviction individual dividend growth stocks. Some of the moves I've already made this year to help get there were selling positions in Clear Secure, ticker YOU, at pretty much break even, Chevron, ticker CVX, for an 85% gain. It was only 15 shares, but it was in the self-directed IRA, and Innovative Industrial Properties, ticker IIPR, for a 60% loss. And I also recently trimmed some Visa out of the self-directed IRA for a 24% gain, because in the self-directed IRA, it's a locked account, meaning that in March of 2020, we took $30,000 from our 401k and rolled that into the self-directed IRA that we opened up at Schwab, and I have put nothing else in, and I do not intend to put anything else into that. So because we only had 6 shares of Visa and we were up almost 25%, I decided to just sell those, lock in the profits, and put that into VTI, which, by the way, the dividend yield on VTI is almost double of what Visa currently is. And these moves are all part of the transition strategy to have about 10 to 15 individual high conviction, mostly dividend growth stock holdings, and currently we're at 14 individual stocks. I can totally hear what some of you are thinking, but Russ, I'm not trying to beat the market. I'm trying to build passive income and get a high yield on cost. That's totally valid, and you should do you and whatever allows you to sleep well at night. But here's my thinking. By going this route, I'm giving us more options by focusing on total return now. And if I want to shift to high yield investments in retirement or even a little bit sooner, I will most likely and hopefully have a larger portfolio to work with. But make no mistake, this doesn't mean I'm abandoning individual stock analysis or dividend growth investing. No, my friend, it's quite the opposite, as I'm still keeping those positions that I have a high conviction in. For example, Harrow Incorporated, which is in my Roth IRA, is my only non-dividend position, but I have a strong conviction in its potential, and having it in the Roth means that any gains will be tax-free. So looking ahead to the 85-15 portfolio allocation, here's my plan, is to continue maxing out my 401k with low-cost index funds, which currently those are the Vanguard Value Index Fund, ticker VVIAX, the US Large Company Portfolio, ticker DFUSX, and for some mid-cap exposure, a small amount goes into the Fidelity Mid-Cap Index Fund, ticker FSMDX, and then directing new Roth contributions primarily to VTI and SCHD, using REIT dividends in my self-directed IRA to buy more VTI and MLPX, the Global X Energy and Infrastructure ETF, and then maintaining non-REIT individual stocks in my taxable brokerage account. Remember, investing doesn't have to be exciting to be profitable, and sometimes the boring choice is the smart choice. I'll still analyze and buy individual dividend growth stocks, occasionally sell covered calls, and share my thoughts with you, but I always want to be transparent about where the bulk of my money is invested on this investing journey we're on. And I know some of you might unsubscribe because this isn't exciting enough, and dude, that's okay. I know we have some fun and shenanigans around here, but my goal isn't to always entertain. It's to build long-term generational wealth for my family and share some of what I'm doing and hopefully help you do the same. After all, I barely graduated high school. I've been in the trades for almost 26 years after leaving the US Navy, and I partied my 20s away and didn't start to get on the financial straight and narrow until I was almost 40. And now at almost 47, I'm closing in on a net worth of $1 million, which is just the beginning. But I think the data and the math are pretty damn clear that low-cost, broad market index funds should be the foundation of most of our portfolios. Now let us know in the comments below what you think about this approach, and in this floating little box next to my head, hey, if you haven't seen my interview with the yield shark Kelly Green from Malden Economics, what are you doing? Click on this floating little box next to my head and we will talk to you there.